Hey everyone, welcome back for another deep dive.
Yeah.
We're really digging into China this time, and honestly, I'm kind of overwhelmed with all this information. Analyst reports, Bloomberg articles, we've even got insights from Goldman Sachs.
Yeah, there's definitely no shortage of opinions on this one.
Right. It's all about their recent economic stimulus efforts and whether this market surge is the real deal or just a temporary blip. So what do we have to work with here? We've got these JP Morgan and SANIC analyst reports painting a pretty vivid picture of the market's reaction, and then some really insightful pieces from Bloomberg laying out the specifics of the stimulus package itself.
And of course, we can't forget that Goldman Sachs report, always a valuable perspective.
Exactly. So let's start with the elephant in the room. China's stock market is going bonkers right now, especially those distressed real estate companies.
Yeah, it's like someone hit the turbo button. JP Morgan's report highlights that on October 2nd alone, the sector shot up by 21%. And get this, distressed real estate companies, they're up a staggering 94% since their recent lows.
It's like everyone's suddenly forgotten about all the risks involved. I mean, are we really supposed to believe these companies are suddenly on solid ground?
Well, that's the million-dollar question, isn't it? JP Morgan seems a bit skeptical. Their report delves into current share prices, price-to-book ratios, all that good stuff, and compares them to historical averages and mid-cycle levels from 2018-2022.
So they're basically saying, hold on a minute, this might be a bit of an overreaction.
It seems that way. For instance, they point out that state-owned enterprises, those SOEs, are currently sitting at a 7.9x price-to-earnings ratio, and their price-to-book ratio is at 0.68x. Now, compare that to the mid-cycle PE from 2018 to 2022. And
Wait, what were those mid-cycle figures again?
Sure. So the mid-cycle PE for SOEs was around, let me just find it.
Yeah.
Oh, here we go. It was around 7.9x, and the PB was 0.68x during that same period.
Interesting. So the market's definitely pricing in a lot of optimism right now.
Definitely. And this is where Sigakic's report offers a really thought-provoking perspective. They draw a fascinating parallel to Japan in the early 1990s. Remember what happened then?
Vaguely, but remind me.
Well, after a period of intense stimulus, Japan's market went through what CITIC calls a three-stage model. Now, they're very clear that it's not a perfect comparison to China today, but there are some striking similarities.
Okay, I'm intrigued. Break it down for me. What are these three stages?
So stage one is this initial surge, this beta rally, driven mainly by valuation adjustments and that flood of liquidity. It's like what we're seeing now.
Makes sense. Everyone's piling in, hoping to ride the wave.
Yeah.
But what happens when that initial euphoria wears off?
That's stage two. Things get a bit more volatile. Investors become more discerning, focusing on stock picking rather than just riding the broad market wave.
So more of a show me the money kind of phase.
Precisely. And this is where it gets really interesting. Because if, and that's a big if, the stimulus measures actually work and we see a genuine, sustained economic recovery, that's when stage three kicks in.
The long-awaited bull market.
Potentially. But it all hinges on those fundamentals actually improving.
Okay, so before we spiral into a theoretical future, let's unpack the specifics of this massive stimulus package that's got everyone so fired up. Bloomberg really lays it all out there. They've got a whole breakdown of the interest rate cuts, both the 7-day policy rate and the medium-term lending facility.
And don't forget those reserve requirement ratio cuts. Those are significant. Basically, they're freeing up more capital for banks to lend.
Right, and it doesn't stop there. Bloomberg highlights a plan to significantly reduce existing mortgage rates. Like we're talking potentially slashing them by an average of 0.5 percentage point. That's huge.
Absolutely. And it's not just about easing the burden on current homeowners. They're really pulling out all the stops to try and entice new buyers to enter the market as well. Lowering down payment requirements for second homes to match those for first-time buyers, for example.
Wow, that's a pretty aggressive move.
It is. And there are even discussions about potentially allowing homeowners to refinance their mortgages with different banks, something that hasn't been allowed since 2008.
So they're really trying to reignite that property market.
Without a doubt.
Okay.
They're injecting some serious liquidity into the system. But it's not just about real estate, you know? They're also taking aim at the stock market directly.
Oh, right. Bloomberg mentioned this whole swap facility designed to help financial institutions buy up equities. And then there's that re-lending facility for companies to buy back their own shares. It's like they're pulling every lever they can find.
They are, and there are even whispers of a potential stock stabilization fund in the works. Plus, they're pumping a significant amount of capital, potentially upwards of 1 trillion yuan, into major banks.
1 trillion yuan. Where's all that money coming from?
Well, they're planning to finance it through the issuance of special sovereign bonds.
Wow, they're really putting their money where their mouth is. But here's the thing. With all this talk of stimulus and market rallies, Aren't we overlooking the giant panda in the room?
Deflate.
Exactly. CITIC's report didn't mince words. They called it China's core problem. And it's not just a cyclical blip. They're talking about a deep-seated structural issue tied to, you guessed it, debt.
They actually use the term balance sheet recession, which is
Yeah.
a pretty sobering assessment.
Right, and CITIC's report states that the biggest economic hurdle they face is getting out of deflation.
Absolutely. And when you look at the data Bloomberg's compiled, it's not a pretty picture. Consumer confidence is in the tank. Remember those earlier attempts to breathe life back into the housing market? They basically fell flat.
So how does this massive stimulus package address that fundamental problem? Is it enough to actually pull them out of this deflationary spiral?
That's the billion yuan question, isn't it? What's interesting is that CIIC points out that China seems acutely aware of Japan's prolonged struggle with a balance sheet recession. They're making a conscious effort to avoid a similar fate.
Okay, so they're learning from past mistakes.
It seems so. They're targeting debt reduction, trying to incentivize private sector involvement, and they're even exploring ways to boost domestic consumption.
Didn't that Goldman Sachs report mention something about dairy consumption vouchers?
Yes. It sounds a bit strange, but it's all part of this bigger strategy to boost consumer spending. They're trying to shift away from that reliance on exports and investment-driven growth.
It's a completely different approach.
It really is.
But hold on a second. JP Morgan's take on this whole thing seems a bit more, shall we say, grounded in reality. Well, while they acknowledge the government's efforts, their analysis suggests the actual impact of this easing might be less potent than investors are hoping for.
Interesting. What are they basing that on?
They're worried that this whole rally is fueled more by sentiment than any real tangible improvement in the fundamentals.
So it all comes down to whether this optimism is justified.
Right, and whether it's sustainable in the long run.
That's the trillion yuan question, isn't it? Do we have a genuine bull market on our hands, or are we just setting ourselves up for another disappointment?
So if we're trying to get through the noise here, what should we be paying attention to? What are the key indicators that this might actually be the start of something big?
Well, JP Morgan makes a really good point about looking beyond the initial sugar rush, those knee-jerk reactions to the stimulus announcements. They're saying keep a close eye on those high-frequency sales data, especially in the major Tier 1 cities.
So basically, we need to see if people are actually buying properties, not just riding the wave of optimism.
Exactly. Are those property sales numbers actually going up? That's going to be a key indicator of whether this recovery has legs or if it's just a head fake.
And it's not just about the numbers themselves, is it? It's about how the government responds if those numbers don't meet expectations.
All right. Remember, JP Morgan expressed some concern that the easing, while definitely present, might not be as forceful as some investors initially anticipated. So how does Beijing react if those sales figures are disappointing? Do they double down? Do they pump the brakes? That'll be very telling.
It's a tough spot to be in. They're trying to stimulate growth without exacerbating those debt concerns. It's a tightrope walk, and the whole world is watching.
Absolutely. The stakes are incredibly high. But amidst all this uncertainty, there's also a real opportunity here. CITIC's report, they really hammered home the importance of successfully motivating and mobilizing all of society. And that includes the private sector, entrepreneurs, everyone.
So it's not just a top-down approach this time. They're trying to get everyone on board.
Exactly. And if they can actually achieve that, if they can convince the private sector to jump in with both feet, well, this bull market could extend far beyond just real estate. We could see a ripple effect across the entire economy.
Now you're talking. So even with all the risks and uncertainties, there might be some strategic opportunities emerging here.
Potentially. Even if, as JP Morgan suggests, this current rally is primarily driven by sentiment, there could still be pockets of value to be found. They specifically point to the property management sector as an area of interest.
Okay, that's what I like to hear. Give me some specifics. What are they seeing in the property management space?
Well, these companies tend to have more stable earnings compared to the developers, right? And they're currently trading at what seem to be relatively reasonable valuations. They highlight CR Mix, for example.
CR Mix, got it. What's their story?
So they're a leading property management company, and their current price-to-earnings ratio is sitting at 21x.
21x. That seems a bit high, no.
Well, here's the thing. That's actually below their 3-year average, which was closer to 15x. So there's an argument to be made that they're undervalued at the moment.
Interesting. Anyone else catching their eye?
Yeah, they also mentioned Longfor, another big player in the property management space. Their current PE is 12x.
Okay, so even lower than CR Mix. Seems promising.
It does, but we have to keep in mind that valuation already factors in some pretty optimistic growth assumptions. So again, it comes back to those fundamentals. Can they actually deliver the goods?
Right. The market's clearly pricing in a significant rebound.
Okay, what about those big name developers, the ones that have been struggling? Is there any hope for them?
Well, JP Morgan did a pretty deep dive on valuations, comparing current share prices to historical averages for a whole bunch of developers, and there are some pretty striking discrepancies.
Like what? Give me an example.
Take Country Garden, for instance. They're a major developer, and right now they're trading at just 0.49x their peak price-to-book ratio from back in 2021.
Wow, that's quite a discount. It is. And it gets even more extreme. Sunac China, another big name, they're trading at a mere 0.25x their peak P/B. So if this recovery gains traction, there's definitely significant potential for growth in that space.
But it's not a uniform picture, right? I mean, some developers are lagging behind while others are surging ahead.
Exactly. And JP Morgan is quick to point out that there are some state-owned developers whose share prices are currently way above their historical averages. Like take China Jinmao, for instance.
Or the train on there.
Well, they're currently trading at a PE of 9.5x, which is significantly higher than their 3-year average of 5.4x. So even within the developer space, there's a lot of nuance. It's not as simple as just piling into anything real estate related.
So stock picking is going to be crucial.
Absolutely. And this is where that point from Siddiqic about the private sector comes back into play. They believe the success of this entire endeavor hinges on private companies and entrepreneurs really stepping up and participating.
They need to see the opportunity and seize it.
Exactly. And there's a sense from their report that they're cautiously optimistic. They see this as a potential confidence reevaluation for Chinese assets as a whole.
A reevaluation, meaning...
Meaning that the government's actions are being interpreted as a clear signal, a commitment to revitalizing the economy, which, in theory, should reduce uncertainty and ultimately boost investor confidence in the long run.
Okay, so there's a method to the madness.
Yeah.
But I can't help but think back to JP Morgan's warnings. They seem to be urging a bit more caution.
Yeah, they definitely inject a dose of realism into the conversation. While acknowledging the potential for a sustained recovery, they're also emphasizing the inherent risks. They point out, for example, that historically there hasn't been a strong correlation between the stock market and home prices in China.
So even if the market rallies, that doesn't necessarily translate to a real estate boom.
Right. They actually drew a really interesting comparison to the rally back in 2015. This time around, they argue that the government is taking a much more targeted approach, focusing on preventing a downward spiral that could drag down other sectors of the economy, like consumer spending. They're not just throwing money at the problem indiscriminately.
It sounds like they've learned from their past mistakes and are trying to be more strategic this time. They're playing the long game.
Exactly. And that's a crucial point for investors to remember. This isn't a guaranteed path to riches. There are going to be bumps in the road, maybe even some detours. Patience is going to be key. Remember, CityX's 3-stage model? They suggest we might be in for a period of volatility before we see a sustained upward trend.
So buckle up. It could be a bumpy ride. For those of us who are already invested or those thinking about dipping their toes in, what's JP Morgan's advice? What should we be watching most closely in the coming months?
Well, they stress the importance of monitoring the scale of fiscal stimulus that's being implemented. Is it enough to move the needle? And just as importantly, they're saying watch the government's willingness to maintain this easing, especially if the economic data starts to disappoint.
Basically, they're saying don't get caught up in the hype. Look for concrete signs of a fundamental shift before making any major moves.
Exactly. It's easy to get swept up in the excitement of a surging market, but a healthy dose of skepticism is always warranted, especially in a situation as complex and dynamic as China's economy.
Wise words. So we've covered a lot of ground here, dissecting China's economic stimulus efforts, the market's reaction, the potential for a bull market on the horizon. It's a complex situation with no easy answers. But you know what's really got me thinking is something that both JP Morgan and CIDIX seem to kind of dance around. But
Yeah.
what if China actually pulls this off?
What if they actually manage to squash deflation and reignite their economy?
Exactly. I mean, think about the implications. The aftershocks could completely reshape the global landscape.
It's like we're watching this high-stakes game of economic Jenga, and the whole world's holding its breath. Imagine a successfully rebalanced China.
A China that's fueled by domestic consumption, and less reliant on debt-driven growth.
Exactly. It'd be a completely different beast on the global stage.
And that's what I think makes this whole thing so fascinating. We've been laser focused on real estate. But what about the other sectors that thrive in a high-growth, consumer-driven environment?
Right. Think about it. A thriving Chinese consumer base could have a ripple effect on everything.
Everything.
Yeah, luxury goods, international travel, sustainable energy, electric vehicles, you name it.
So China's battle against deflation suddenly becomes everyone's roadmap for global portfolio plays.
Potentially, yeah. It's like everyone else is glued to the real estate game, but we're already thinking 2 steps ahead.
Anticipating the next wave. I like it.
That's the beauty of a deep dive like this. We're not just giving you the news, we're giving you the whole context.
We're giving you the tools to understand it.
Exactly.
So, to wrap things up, we've really gone deep on China's economic stimulus efforts, the market's reaction so far, and the potential for a major bull market in the making. It's a complicated situation. There are a lot of moving parts.
And no easy answers.
But hopefully, this deep dive has given you a new lens to view these developments through.
And remember, even if you're not directly invested in China right now, this is a global game changer. What happens there has the potential to impact all of us. So stay informed, stay engaged, and as always, thanks for joining us for another deep dive.